The Nasdaq market is now closed, with Plug Power Inc. having finished the trading session on November 19, 2025, at a closing price of $1.90, representing a significant drop of 11.2% for the day. This steep decline pushes the stock back near a critical psychological and technical support level, a move that undoubtedly has many investors concerned, especially given the stock's persistent history of volatility. But here is the critical insight that the surface movement misses. This massive daily drop was not primarily driven by a new operational failure or an unexpected catastrophe in the hydrogen business, but rather by a planned, albeit poorly received, financial maneuver: the announcement of a $375 million convertible senior notes offering. The market's immediate expectation was clear: dilution and a fear of the worst. The reality, however, is a messy but calculated effort to restructure high-interest debt and fortify the balance sheet, which is a necessary, if painful, step toward long-term financial viability, forcing us to reevaluate whether this drop is a panic-driven overreaction or a justified response to a persistent cash problem. The common, almost reflexive narrative around Plug Power is that it is a pure-play hydrogen growth stock poised to capture a massive market as the world shifts toward decarbonization. Proponents focus on the company's impressive backlog of electrolyzer orders and its expansive plan to build out a green hydrogen network, citing its foundational position in a sector that is receiving substantial governmental support through initiatives like the U.S. Inflation Reduction Act. The expectation is that this build-out will soon hit an inflection point where revenue growth outpaces cash burn, leading to profitability. Today's reality check came in the form of a financing round that highlighted the immense capital cost of executing this grand vision. The decision to issue $375 million in 6.75% convertible senior notes, primarily to pay off high-cost 15.00% secured debentures, is fundamentally about survival and operational efficiency, not growth per se. It confirms the market's deep-seated fear that the company remains profoundly capital-intensive, running on a continuous need for external funding just to maintain operations and service existing debt. This financial restructuring, while fiscally sound in the long run by replacing expensive debt with cheaper debt and equity-linked instruments, signals that the path to self-sufficiency is longer and more demanding than many shareholders had hoped, triggering the violent sell-off we observed. Zooming in on the recent price action, the 11.2% drop yesterday was accompanied by trading volume soaring to over 218 million shares, dramatically exceeding the average volume of around 97 million. This volume spike confirms a mass liquidation event, where weak hands were shaken out by the convertible note news. The intraday low hit $1.70 before a slight bounce back to the $1.90 close, demonstrating that some buying interest remains near the low end of the stock's recent trading range, a range that has been under pressure since the Q3 earnings report on November 10th. That earnings report, while showing a slight EPS beat against a negative consensus estimate, also revealed a revenue miss and, more importantly, confirmed a net negative margin of over 290% and a high rate of cash usage. Institutional investors have been repositioning in response to this financial strain. We are seeing a pattern of cautious reduction in exposure, as evidenced by recent 13F filings. Small stakes were acquired by firms like Kovac Advisors and UCF Capital Management, which reads more like speculative buying at a low price rather than a strong conviction signal from a major fund. Conversely, insider selling, like the recent sale by an EVP, adds a layer of concern, however small the actual share count. When executives sell stock after a significant dip, it rarely reassures the retail crowd, fueling speculation and negative sentiment on forums like Reddit and X, formerly Twitter, where the dominant thread is now one of desperation and accusations of management mismanagement. Now, let's address the elephant in the room: short-selling awareness and pressure on Plug Power. This stock is and has been a short seller favorite for years, and the current financial precariousness has only emboldened them. The most recent short interest data as of October 31, 2025, shows a substantial 310.6 million shares sold short, representing a staggering 23.73% of the public float. The days-to-cover ratio stands at approximately 2.96 days, which, while not in the extreme squeeze territory of 10-plus days, is high enough to indicate that short sellers would face a significant challenge and high volatility if a sudden surge of buying interest materialized. The borrow fee rates have been remarkably low and steady around the 0.55% mark, which is a key insight. Shorting Plug Power is incredibly cheap right now. This low cost means that established firms, such as the ones whose names often surface in major short reports like Morgan Stanley, who recently maintained a sell rating and a $1.50 price target, can comfortably maintain their large bearish positions without the pressure of high daily fees, allowing them to patiently wait for a sustained breakdown. This dynamic presents an actionable insight for retail investors. The low borrow cost suggests a short squeeze is unlikely to be triggered by short seller pain in the immediate term. Any major upward movement would need to be driven by significant fundamental news, not a cost of carry failure for the short side. Actionable advice on this front involves tracking a few signals. First, monitor the short interest percentage in the next mid-month and end-of-month NASDAQ reports to see if the recent sell-off has led to a major capitulation from short sellers covering their positions, or conversely, if they have doubled down. Second, keep a close watch on the options open interest, particularly the put-to-call ratio, which is currently sitting around 0.30. This low ratio suggests that options traders are still relatively more bullish via call options than bearish via put options in the overall long-term picture, which is a counterpoint to the raw short interest data. Finally, investors must understand the risk of chasing a short squeeze. Plug Power's price history is littered with sharp, short-lived rallies followed by steep declines. Chasing a volatile upswing fueled by short covering is purely speculative and carries a high risk of being caught in the subsequent downturn. Instead, responsible investing dictates waiting for fundamental validation of the hydrogen business model. To understand the long-term context that the short side is betting against, we must look at what Plug Power actually does. The company is vertically integrated, building a complete green hydrogen ecosystem. This includes manufacturing electrolyzers, which use renewable electricity to split water into hydrogen and oxygen, operating a logistics network for storage and delivery, and providing the final product through its GenDrive fuel cell systems for material handling, forklifts, which is its current primary revenue driver. The bull thesis centers on the fact that hydrogen is a clean, energy-dense fuel critical for decarbonizing hard-to-abate sectors like heavy-duty trucking, logistics, and industrial processes. Older reports highlight their early success in the material handling space, securing large clients like Amazon and Walmart, which provided a base of recurring revenue. However, the consistent older report pattern is one of massive capital expenditure and negative operating income, a reflection of the high cost of building out a distributed hydrogen production and liquefaction network from scratch. The shift to producing green hydrogen, which requires significant upfront investment in electrolyzer plants, is what is draining the cash reserves, leading to the continual need for dilution and debt. The bear thesis, currently expressed by short sellers like Morgan Stanley and others, is precisely that the company's costs will perpetually outstrip its revenue, turning the growth opportunity into a value trap as they are forced to dilute their shareholders repeatedly just to fund their operations. The future outlook for Plug Power hinges on two major catalysts. The first is the U.S. Treasury Department's final guidance on the Inflation Reduction Act's Section 45V Clean Hydrogen Production Tax Credit. The stringency of the final rules, specifically whether they adopt the three pillars rule regarding additionality, deliverability, and hourly matching of clean electricity, will determine the economic viability of Plug's domestic green hydrogen projects. If the rules are too strict, the cost of production rises dramatically, undercutting the economics of its entire North American strategy. The expectation is for a favorable or at least workable compromise, but the reality is still uncertain. The second catalyst is the successful commercialization of their large-scale hydrogen plants, which is intended to lower the cost of green hydrogen and flip the operating expense structure from a loss to a profit. Management projects significant progress toward cash flow positivity within the next few years, but these projections have continually been pushed back, creating tension between guidance and delivery. The risk is immense. Continued cash burn combined with a tightening credit market or unfavorable regulatory guidance could necessitate another dilutive capital raise, punishing shareholders further. The opportunity lies in one major non-dilutive contract win or a surprisingly favorable final IRA rule that dramatically improves the unit economics. The core tension in Plug Power is between the compelling macro-level need for clean hydrogen and the microscopic quarter-to-quarter challenge of operating a capital-intensive